This is Bloomberg Intelligence.
The new tools that a metaverse can bring allows you to create more immersive content.
Companies are beginning to sell less oil, more electrons.
In-depth research and data on 2,000 companies and 130 industries.
The supply chain breakdown is combining with labor shortages.
Will Eastern manufacturers continue to dominate, or will there be a renewed interest in Western manufacturing?
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we will dig inside the big business stories impacting Wall Street and the global markets. Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we break down earnings from the biggest banks on Wall Street. Plus, even though Apple has returned over $630 billion to shareholders over the past decade, the payouts are not slowing down. But first, let's dig into the media space. We've had a lot of M&A over the last several years. Big media companies trying to get even bigger to compete against some of these technology companies. Let's bring in Geetha Ranganathan, BI Senior Media Analyst. So, Geetha, one of the deals was Warner Brothers, which was part of AT&T, got spun out of AT&T, merging with another pretty good-sized media company, Discovery Communications. So now we have Warner Discovery, very apt, pithy name. Talk to us about this new company here, Warner Discovery. How does it fit into the big media landscape?
Absolutely, Paul, and thank you. Warner Brother Discovery is created really a new media heavyweight in the media space. This is the second largest media company after Disney in terms of revenue. Really the aim here was for them to not just kind of merge their linear TV assets, but to really go after streaming in a very, very big way. And if you kind of just look at the portfolio of the two companies, it's a very, very complementary portfolio. So you have Discovery, which kind of specializes in reality TV, in nonfiction content. And then with HBO Max, you really have, a brand name in terms of scripted dramas and originals. And so now you really have this very complementary portfolio which can kind of go after the big streaming players that are that have already kind of gained a lead, whether it's Netflix or Disney. But this combination definitely offers a unique proposition to consumers.
Yeah, it's interesting. A lot of content, when you think about Warner Brothers, one of the leading studios in Hollywood, plus, as you mentioned, all the great programming that Discovery's and all their cable networks have. But again, the big issue, which I know you've been writing about for the past few years diligently, has been this, kind of change in the media business from one that was based upon cable systems, satellite dishes, to one that's now streaming based. Where are we in that evolution, and will it ever be a really good business for these media companies?
A lot of the focus now has really shifted away from just simply, streaming subscriber growth to now kind of scrutinizing the earnings potential of these businesses. And I think the general sentiment is now veering towards a realization that maybe, the new business model, yes, you can achieve subscriber scale, but it is going to come at the expense of profits. And what we've seen is, if you look at the traditional cable business, it has generated over $100 billion in revenue every year for these big media companies, and also very, very healthy Ebitda margins, 35 to 40% Ebitda margins. The problem with streaming is, you're really kind of trading those analog dollars for digital pennies. And so, yes, you can get scale, but then, the streaming wars have now kind of almost evolved into these spending wars. And you have all of these companies spending something like $150 billion $150 billion just to kind of feed that streaming beast, if you will. And what that results in is obviously huge losses, and it's going to take a very long time for any of these companies to kind of even break even on their streaming businesses.
It doesn't sound like an environment where these stocks can perform. Like, you want to own these things? What are people thinking about this media space now?
I think what's going to happen is investors are really preparing for a shakeout. Obviously you have Disney and Netflix, which are kind of heading the streamers, but Amazon and Apple are also kind of quietly sneaking in and trying to get a stronger and stronger foothold. Of course, with Warner Discovery, I think we have a very credible top tier streaming player. But again, there's a lot of nervousness in the market right now, not just with a general slowdown in the streaming subscription business, but also about whether they can, generate sustainable profits. And so what we're seeing right now is most of these companies, yes, they're in the midst of this streaming pivot. Almost all of them have streaming platforms, but at the same time, they are forced to make sure that their linear TV businesses are also generating healthy profits, and they have to keep those businesses running because that is what is ultimately fueling all of these streaming projects. So if you look at Warner Brothers Discovery, for instance, they're going to probably generate about $12 billion in Ebitda in fiscal 2022. But almost $9.5 to $10 billion of that is going to come from the traditional TV business. In fact, they might almost lose about $2 billion on their streaming business. So really, it's so important, it's so critical for them to kind of maintain or have stable revenues from the old model.
Geetha, is there any sense of how many streaming services the market really needs or will bear? Is it 1? Is it 5? Is it 10? Do we have any sense about that yet, or is it still too early to call?
It's still evolving, Paul, but I think we've generally seen about 5 to 6. That's where it's kind of settled in, with people willing to spend anywhere from about $60 to about $65 per month in the United States. That actually brings us very close to what a traditional TV package used to cost, which is about $70, $75. Yeah. So we'll have to wait and see how it plays out, but I don't think consumers are going to want to have more than 5 services.
All right, Geetha, good stuff there. As always, Warner Brothers Discovery, that's a new big media player on the block, and Geetha's got some good research out on that. Geetha Ranganathan, Senior Media Analyst for Bloomberg Intelligence. Coming up on the program, we take a look at how Apple's massive returns are set to continue. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. It's 13 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Well, we've had most of the big banks report their quarterly numbers. I thought they were generally pretty good. I know the comparisons are getting more difficult, but the world's getting back to normal. But let's get a quick review of what we saw from the big banks and what their outlooks are. We bring in Bloomberg Intelligence banks analyst Alison Williams. So, Alison, we had the big guns, the big U.S. investment banks report over the last week or so. What are some of your key takeaways?
So the key takeaways are that they are executing in a difficult environment. They have tremendous upside to short-term interest rates. So that's exciting. Loan growth coming through, especially on the commercial side. That's great. There is a rising risk of a recession, so that's no surprise, and that's something that cannot be disproved, obviously, this quarter. I guess on the negatives were the fact that many of the banks had sharper declines in their capital ratios than expected. And this really relates to sort of an accounting impact that relates to long-term interest rates. So basically, long-term interest rates go up. The value of their bond portfolios go down, thanks to Basel III. That runs through their capital ratio. So it works out over time, but we're going to get a little bit less buybacks in the near term. But net, as I said, executing in a tough environment.
How about the trading environment? Because that's been Wall Street's like when we went into lockdown, I said, no way they're going to be able to trade from home. I'm used to going out onto the trading floor of Morgan Stanley or Salomon Brothers and seeing hundreds and thousands of people trading all kinds of securities. They can't do it from their couch, but they did, didn't they?
They did. And this quarter, again, trading better than expected. FICC was really sort of the standout, whereas last year it was really equity trading that came in a lot to the upside, but equity trading also better than expected this quarter. And so a lot of that really had to do with the volatility and the volumes in March. So that was helpful. Fees fell more than expected. That was a big focus that we talked about going into the quarter. But the surprise on the upside in trading really was better than the downside to fees.
That's the capital markets side of the business. The lending side of the business, a couple of things. Net interest margin. Interest rates are going up. So can this finally be a good story for the banks?
It is finally going to be a good story for banks. And that's really where I think we're going to be getting the upside in the coming months. Some of the banks basically doubling their guidance in terms of looking at the upside just given where we've moved on the forward curve. So this quarter we saw some positive benefit, but keep in mind we only saw that rate rise coming in late in the quarter. So I think the banks are really looking ahead. And so that's really going to be a positive, especially for banks like Wells Fargo and Bank of America.
That's kind of what I think of when I think of, making those corporate loans, commercial loans to small, mid-sized businesses and the large corporate loans. I remember over past quarters, Jamie Dimon and others saying people just aren't borrowing as much as they typically do. And I guess it's because of all the stimulus that came into the economy. Are we going to see some loan growth here?
The stimulus has been what has sort of prevented loan growth, if you will, but we have seen that starting to come back, especially on the commercial side of things. We began to see some positive signs in the fourth quarter. We've seen some follow through. On the card side of things is really where we saw some of the effects of the stimulus in terms of the fact that consumers are healthy, they're spending, but they're not borrowing. They're spending and paying those loans back. What we saw in this quarter were some signs that consumers could start to be borrowing. A lot of that is in the private label side that we saw at Citigroup, Synchrony Financial, which is another credit card lender that focuses on those types of loans, seeing sort of better growth. So this is a type of consumer that generally has lower income, lower credit limits. So perhaps just those inflationary costs hitting the spending more and leading to a bit more borrowing.
All right. My favorite topic when we talk about your big investment banks, compensation. Everybody, all the little analysts out there are getting paid lots of money. I started in 1986 as an investment banking analyst, $22,500. Now the kids coming out of school are making a lot more than that. And I'm wondering, is that kind of impacting the entire compensation structure?
So it is. And I think there are three things I'd make note of there. The first of which, we did see at Morgan Stanley and Goldman Sachs a lower compensation ratio as compared to a year ago. So keep in mind, these are accruals because, as we also know, bonus is a big part of it. So the accruals are a little bit lower. That could be a signal that things are getting a little bit less competitive. However, the banks, as we said, good trading quarter. On the pipelines are still strong. They're calling it a stall. We'll see if the market window opens up and those deals come to market. But sort of still a sign of optimism there. But then the other couple of factors I'll point to are just one, there's been a cyclical trend. We had record IPOs last year, record M&A, a lot of volume. So it's obviously not surprising that compensation would be hitting new levels. But there's also been years and years of structural, sort of ignoring investment, like not investing in research. Years and years of structural underinvestment in research. Yes. and so I think that there's a little bit of a catch up. So I think some of it's structural in terms of lifting salaries, which had sort of paused for a long time, things becoming a lot more competitive. And some of it is a little bit cyclical. So we'll see how the year shakes out.
The great financial crisis, 2008-ish, the result of that was a lot of new regulation to limit some of the risk profiles for these big financial institutions, and that had the obvious result of reducing the amount of returns these businesses could generate for shareholders. Give us a sense of how the return profile of this industry looks now. I would think it's a lot better than it was back in 2008, 2009.
It's definitely a lot better than at that time. And as I said, it's sort of remarkable, some of the returns that we're seeing this quarter. Now, a lot of that has to do with still strong capital markets, asset and wealth management. Granted, the run rate's a little bit weaker, but still executing. So Morgan Stanley turning in a 20% return. That's obviously very good. Yeah. And as I said, the other banks also doing pretty well in this environment. The other factor I'd point to is, trading is a bit different business. There was a lot more risk taking sort of back in the day. That's one question I've been getting is, will the regulators look at trading? But we can point to so many factors that show that it's client activity that's really surging. Hedge funds, another industry that's really recovered and doing well. average client balances basically close to a record. That's also helping to fuel the banks.
All right, Alison, good stuff. As always, some good numbers coming out of the financial services sector. That's Alison Williams. She's a chief banks analyst for Bloomberg Intelligence. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. It's 25 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts, covering some 2,000 companies and 130 industries worldwide. All right, I'm looking at Apple Computer. If you look at the balance sheet, $200 billion in cash, $120 billion in debt. So net cash is called roughly $80 to $100 billion of net cash. What do they do with it all? So in order to get an answer, let's bring in Bloomberg Intelligence analyst Rob Schiffman. He follows a company from a credit perspective. So, Rob, again, this is a story, this is a discussion you and I have had repeatedly over the years. What does Apple do with all of its cash? Tell us what they're doing now.
Well, you're not allowed to have a favorite child, but you certainly can have a favorite credit. And Apple is the gift that keeps on giving. They issue tons of debt. They generate tons of free cash. They buy back $100 billion worth of stock, and everyone owns a product. So they all have an opinion on what the company does and what it should be doing, and in particular, what it should be doing with their money. So listen, over time, it's very clear what they want to do. They want to move to net cash neutral. That means the same amount of cash as debt. But like you said, they're off by $80 billion. So what do? Well, in the meantime, you buy back $80 to $100 billion of stock, you give back $15 billion in dividends, and you still can't even get back to where your target is because you're generating $100 billion of free cash. So listen, our view is I think they're going to meaningfully increase shareholder buybacks. They're likely to do it this quarter and reload on their buyback program. And they're going to continue to look for M&A. But ultimately, this is a shareholder return story, not a M&A story.
All right. So one of the things that they could do, I'm looking at my DES screen for Apple, and I see they have a dividend yield of only about 0.5%. Why not jack that up to 1.5% to 2.5%?
Yeah, listen, Apple wants to be considered a growth story. You know, you don't have a $3 trillion valuation because you're paying a huge dividend. So quite frankly, I think they're going to continue to pay a larger and larger dividend. But ultimately, that's going to be a smaller piece of their capital return program. I think they want to keep an enormous kitty outstanding that if in the future they want to spend a lot more on certain other products and services, maybe say an Apple car, not just the software in a car, but they want to be the next Tesla and build a car, that's going to require a lot of money. So, it's sort of twofold. One is they want to be considered a growth company, so you don't pay an enormous dividend, at least on a percentage basis. And two is I think that they want to have ample financial flexibility to invest whatever they want, whenever they want, in any product or service.
All right. So on the M&A front, we always talk about it. And certainly whenever a big media company over the last decade would come up for sale, a lot of folks would say, boy, this is the time for Apple to not dip their toe in the content business, but to really jump into the deep end. Yet they've never done that. So is that kind of put on the sidelines a big transformative acquisition?
Yeah, I don't think the government wants to see a name like Apple do a transformative acquisition. There are some big deals out there. Listen, Microsoft's getting bigger into the video game industry. They're spending nearly $70 billion of cash on Activision. MGM was just bought by Amazon for close to $10 billion. But what's out there? I mean, are they going to write a $50 billion check for Twitter? I don't think that's what their path is. There are other ways to spend money, though. Listen, they spend $25 billion a year in research and development in order to create a pipeline of products over the next 10 years to generate $400 billion, $500 billion, $1 trillion in revenues. R&D is going to be absolutely critical. Also, in terms of content, I do think there's other things out there. And on the sort of fringes, it might not make a difference in how much cash they have, but let's say they want to get more involved on the media side. Instead of maybe buying a Twitter, why not go after the NFL And DirecTV packages over at the end of this year, reportedly they're paying $2.5 billion a year for football rights. What if Apple just writes a $10 billion a year check or $15 billion a year check to buy the rights for the next 10 years? You know, they do an A-Rod style Francisco Lindor contract, and they just buy out the rest of the market, and they pay something that's silly. So I think there's things like that they can do. You know, again, there's other things like, you know, what is Meta doing? You know, they're talking about the metaverse. I'm not so sure they're doing anything. You know, Apple probably wants to sell $3,000 AR VR headsets. You know, maybe they can put, you know, another $5 or $10 billion into headsets. So I think that's probably what they end up doing. You know, do they go after something that's $100 billion, $200 billion style acquisition? I think if they try, the government likely shuts them down anyway. So I think they'd rather pour that money back into their own business.
All right, Rob, good stuff. Bloomberg Intelligence analyst Rob Schiffman. Coming up on the program, the war in Ukraine could cost insurers more than $30 billion. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. It's 39 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, one of the silver linings of the past 2 years in this pandemic has just been how quickly and how well these biotech companies, these big pharma companies brought vaccines to the market. Just extraordinary. When you really think about it, it was 1 year, and it's just extraordinary. And now, obviously, it's been a lifesaver for so many. But let's take a look at the business of these big pharma companies as we kind of come out on the backside of this pandemic for many parts of the world. Let's bring in Bloomberg Intelligence analyst John Murphy. John, again, boy, those big pharma companies, whether it's Pfizer or Moderna or whomever, really did an extraordinary job during the pandemic. Give us a sense of how the last 2 years has been for those pharma companies in terms of their business, and then kind of what are you looking for now, maybe in a little bit more of an endemic type of world?
Yeah, I think that's a good question. We've really seen a divergence here, I guess. We've seen the companies who were involved in the COVID vaccine and then in latter days COVID antibodies, and they've had a lovely tailwind, a strong tailwind behind them. Obviously, they brought really impressive technology in terms of the vaccines, and more recently we've seen it in terms of the COVID tablets that have been brought through by Merck and Pfizer, antibodies by others. And clearly they've done particularly well out of it. For the others not involved directly here, or maybe like a Roche who's got a diagnostics business, you know, they've suffered alongside the others, whereby the lack of ability for patients to get in and see their doc, for example, has meant that some of those businesses have not been so strong. But clearly, you know, the COVID tailwind has not only helped them from a top-line perspective, but there's really been some very significant cash flow generated here. And I think the belief now is that we're going to see continued M&A in this sector going forward, particularly from some of these larger companies, for two reasons. A, the cash is there to drive the top line harder, or B, where perhaps that top line's not really growing as much as they and investors would like to see that investment to acquire some pipeline and to improve the outlook there.
Yeah, you bring up M&A, and that kind of got lost a little bit over the past couple of years as the focus was really on vaccines and so on. But boy, your business, it's almost every Monday there for a while. We'd come in and there'd be a mega deal. And I kept saying to you and to Sam Fazeli, your partner over there, is there anybody left? So how do you think about the M&A space? Is this just big pharma buying up the biotech, whoever's got the hot new drug?
Yeah, that's a good question. And I think now it is quite interesting, because I think if you sat down opposite a few biotech investors and sat down opposite a few pharma investors, they'd have a very different view on this, because some of the biotechs have suffered quite a bit. And, you know, it's interesting, you speak to pharma managements and they say, okay, we've seen the biotechs, you know, under pressure here, but we don't think they've got any cheaper, or it's they're more attractive right now. But let's just look at some of the stats. If you look at Pfizer now, we calculated 10 billion revenues from COVID. They throw off about 7 billion of cash. They get that 7 billion to the bottom line. So you're talking about an awful lot of cash being generated here. What we're seeing and what we're hearing more and more from a lot of the large caps is They don't want to go out there and buy big companies. What they don't want, Paul, is they don't want to go and buy shiny new headquarters. They don't want to bring on a big sales force. But what they're all interested in, they're all interested in products that are going to boost their top line. So whether it's Pfizer, because, for example, the market doesn't seem to have a lot of visibility on the pipeline or maybe a lot of belief in it outside of COVID, or whether it's someone like a Bristol that's got a couple of products going off patent in the next couple of years. And again, the market really wants to see a little bit more growth coming through. We would expect these companies to start locking on growth by making selective acquisitions. Now, What I mean by that, just to be clear, is I'm not thinking 20, 30, 40 billion, some of these big deals, but smaller, maybe single digit, things that bring in mid to late stage products that look like they're going to complement and hopefully going forward drive that top line.
Hey, John, we're going into a rising interest rate environment here. How do the big pharma names typically perform in that kind of environment?
Yeah, not especially well. That's right. From a macro perspective, don't tend to do particularly well. What we've seen, and you'll be well aware of that there's been a flight to defensives in recent months for obvious reasons. Some of the terrible things that are happening out in Eastern Europe right now, and we're seeing as a result of that, pharma is benefiting. I suppose add to that as well, we haven't had the major U.S. drug pricing concerns that people were expecting. Anna mentioned that the cash being thrown off as well, and some of that being returned to investors, be it in terms of dividends or buybacks. So I think when you look at valuation right now, the belief is probably that this sector's got ahead of itself a little bit. And to be fair, in recent week or so, we've seen a bit of profit taking. So we would expect that the sector is going to come back to more reasonable levels, particularly as the macro environment gets a little bit tougher out there.
All right, John, that's really good stuff. Really appreciate getting your time. Bloomberg Intelligence analyst John Murphy. All right, the hot war in Ukraine is obviously front and center of every newscast, and it's obviously having impacts across the economy. One of the areas we want to look at now is the insurance business. We turn to Bloomberg Intelligence analyst Charles Graham. Charles, again, a terrible situation in Ukraine, the devastation, the physical devastation, the loss of life, just enormous, like we haven't seen in such a long time here. From an insurance perspective, can you put a dollar number on what we're seeing there?
So direct losses from Ukraine will be limited because the majority of property and life policies will exclude war generally. But having said that, specific areas of the insurance market write that business back so that you have cover for political risks, for aviation war and marine war. So we're thinking that we could well see, and this is a broad consensus that is beginning to emerge, losses at this stage are perhaps up to sort of $15-16 billion coming into the market as a result of the Ukraine war. And that includes the assumption that there will be at least some losses arising from the aircraft leasing risks of the 500 or so aircraft that are currently in Russia and haven't been able to be repossessed by the aircraft leasing companies.
Explain to me, and probably to our listeners as well, what is reinsurance and how does the reinsurance part of your business kind of fit into this?
Well, reinsurance provides protection for insurance companies against exceptional risks. So if you're talking about a major natural catastrophe event, or even risks of like these exceptional sort of political risk or aviation war or marine war risks, then you would expect perhaps up to 50% of that to be underwritten by the reinsurance company. So they essentially provide protection for insurance businesses to enable them to maintain fairly consistent earnings.
All right. So just in the very simple, but unfortunately very real case, if my home or my business was literally destroyed by war, is that covered? Will I be covered in that?
Probably not.
Ugh.
But if you're a multinational company and you're operating in countries that you perceive to have a significant political risk either of war or of a government deciding to nationalize your business and take your assets, then you can buy additional protection. And similarly, in certain specific areas like aviation and like marine, if there is a conflict area, then a distinction will be made that in order to operate in that area, you need to pay an additional premium, for example, for a marine risk, for a number of days that the ship might be at risk.
So How about the Russia? We've seen industry after industry after industry around the globe pull back from Russia as much as they can. Give us a sense of how the insurance industry and what the exposure might be there.
Well, we have a number of insurers that have minority interests in significant Russian insurance companies, particularly AXA and Generali. And what they've done there is they've sought to distance themselves from those assets. So the board members have resigned from the board of those companies. They're not taking any participation in those companies. Generally speaking, they're not big contributors to profits. But it does mean that they're left with the balance sheet value of those stakes. So that is, something that those companies are going to have to deal with at some point in terms of whether they write down the value of those assets, whether they assume that when we have a settlement, that all of this will in some way blow over and that they will be able to actually sell those businesses or continue operating depending on what they choose to be.
So how have your European insurance stocks, how have they fared over the past couple of months as the world comes to grip with, the pandemic in many parts of the world winding down, but the real hot war in the Ukraine heating up?
Well, and on the whole, they've been recovering quite strongly, partly driven by expectations of higher interest rates, which, of course, on the whole is very positive for insurance companies. But with the outbreak of war, shares inevitably dropped very sharply, but since then have largely rebounded. We are, however, beginning to see some adjustment as the realization that insurance companies may face some losses, particularly reinsurance companies may face some losses from these events. For example, we had SCOR, the French reinsurance company, have a profit warning on Friday where they announced that they expected to see both claims from the Ukraine war and also from what's been quite a busy quarter for natural catastrophes, which will result in them reporting a loss for Q1. But this is likely to be an earnings event. The sector and the reinsurers particularly are extremely well capitalized. So, although this is very early days and we're often talking about potential losses rather than losses that we know for sure have already been incurred, this would still seem to be a manageable event in the wider scale of things for the insurance industry.
Bloomberg Intelligence analyst Charles Graham. He covers all the insurance companies from our London office. Thanks very much, Charles. That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. It's 57 minutes past the hour, and this is Bloomberg.